The challenge is usually when there's so many fair value gaps. That is the challenge. You get confused at that level because now you're like, is it going to be this one or is it going to be the other one? You're wondering what is going to be down here or this one down here, or is it going to be this one down here? And the mistake most traders make is they now start trying to use the extreme level. The market is not always going to come to the extreme level. If we're massively bullish, the market will not need to come to the extreme level. In fact, the market will literally go to a shallow level and continue high. Let me show you an example. So let's go to weekly time frame. Now, on the weekly time frame, you can see that we have a range low here. And we'll also have a range high here as well. Now, if you draw your Fibonacci from that range low to the range high, you can see how price came to this fair value gap. Literally
Yes.
a pinch. So right here is, can you see that right there?
Yes, sir.
It literally was just a pinch
Yeah.
to that equilibrium discount mitigating the fair value gap. Now, imagine if you were like, oh, yeah, I wanted to come to extreme level. I wanted to come to this lower fair value gap. How do you know it's going to come to the lower fair value gap? You're not a market maker. So how are you going to know that this is the one it's going to come down into? Or this is the one? You basically don't know. The only thing you're doing is looking for the key levels and waiting for a reaction. Be reactive. Don't just jump in at random areas. Mark your zones. Yes, this is our first point of interest. This is the second one. We don't know which one the market will use. But what we know is we're bullish. That's what we know. And whatever the market is doing, it's still going to continue higher.